Imagine knowing a massive, explosive corporate secret.
Oh, the kind of secret that is mathematically guaranteed to tank a company's stock by tomorrow morning.
Yeah, exactly. So you log into your brokerage account and you're frantically trying to sell your shares today, only to realize the market has, well, it's already priced your secret in.
Right.
The stock has already dropped.
It's a nightmare scenario.
It is.
Yeah.
And how is that even possible? I mean, how can a public market know a private secret before it's even announced?
It sounds like science fiction.
It really does. But today, for you, the listener, we are decoding that exact mystery. We're doing a deep dive into a really fascinating set of university-level financial management notes.
Yes, specifically topic 3, financial markets.
Right, compiled by Mr. Namasi from KCA University. And our mission today is to translate this pretty dense academic text into a practical toolkit for you.
We're going to explore the hidden plumbing of the economy.
We'll take a walking tour through the stock market zoo and finally answer that ultimate question every investor asks.
Can you actually beat the market?
Exactly. Okay, let's unpack this.
Well, the best place to start is beneath the surface of those markets. We need to look at the structural plumbing.
The pipes.
Right, the pipes. The notes emphasize that financial markets exist to move capital from surplus units to deficit units.
So from people who have extra money to people who need it.
Exactly. But to an audience already familiar with the basics of saving and investing, the interesting part isn't that money moves.
Right, it's how it moves.
Yeah, and it rarely happens directly. I mean, we rely almost entirely on financial intermediaries.
Okay, so we're talking about like commercial banks.
Commercial banks,
Yeah.
SACSOs, pension funds like the NSSF, life insurance companies, all of those.
Because if we look at a modern economy, everyday people are, they're kind of like the raindrops, right? Bringing the capital.
I like that analogy, yeah.
And businesses are the farms that desperately need that water to grow their crops.
Mm-hmm.
The intermediaries, the banks, they're the reservoirs and the pipes. But, and here's my question, if we're trying to build an efficient system, why build the reservoirs at all?
That's a common question.
Right. Like, why can't everyday savers just lend their money directly to the businesses and cut out the middleman's fees? I mean, we have the internet now.
True.
Crowdsourcing capital directly just seems, well, vastly more efficient on paper.
What's fascinating here is a mechanical concept the text refers to as maturity transformation.
Maturity transformation, okay.
Yeah, and it's the primary reason those reservoirs are absolutely non-negotiable. Direct lending sounds great until you collide with the inherent conflict of time.
Conflict of time.
Right. As a saver, your absolute priority is access. You might need your money next month for a medical emergency.
Or, tomorrow to fix your car.
Exactly. You want to lend short term?
Mm-hmm.
But a business building a manufacturing plant, they need a 20-year loan.
Oh, right. They can't just...
They can't pour a concrete foundation if you might suddenly demand your money back next Tuesday.
That makes a lot of sense. So the intermediary steps in to absorb that temporal friction.
Yes. Temporal friction is a great way to put it. They bridge the gap between a saver's need for immediate access and a borrower's need for long-term stability.
So they're taking on the risk.
They'd effectively borrow short from savers, and they lend long to borrowers. By pooling thousands or millions of short-term deposits together, a commercial bank achieves the statistical certainty required to hand out a 20-year mortgage.
Or a massive corporate loan.
Right. They know, mathematically, that not every single depositor will ask for their money back on the exact same day.
Unless there's a bank run, but yeah, normally they're safe.
Exactly. So they absorb the liquidity risk, repackage the capital, and perform all the heavy lifting of credit analysis.
Wow.
Without that maturity transformation, large-scale capital formation it completely collapses.
That totally reframes the entire banking sector for me. I mean, they are just holding money. They are actively manipulating time.
They really are.
And if intermediaries exist to manage different time frames, it makes sense that the distinct arenas where this money gets traded are also divided by time, right?
Precisely. The notes classify financial markets into money markets and capital markets, based entirely on the clock.
Okay, so let's break those down.
Sure. The money market is strictly the arena for short-term funds.
Meaning under a year?
Exactly. Instruments that mature in under 1 year. We're talking treasury bills, commercial paper, bills of exchange.
So this isn't really for you and me.
No, this is the institutional playground. It's where banks, large corporations, and governments go to manage their immediate day-to-day liquidity needs.
It's essentially the overnight plumbing of the financial system.
That's spot on.
Whereas the capital market, that's the arena for the long game.
Yes, this is where you find long-term funds, maturity periods of more than a year.
Or instruments with no maturity date at all, right? Like ordinary corporate shares.
Exactly. But within that capital market, the notes highlight a massive divide that dictates how our entire global economy functions.
And that's the split between the primary market and the secondary market.
Right. The primary market is where securities are born.
Like an IPO.
Yes, in an initial public offering. When a company issues shares for the very first time, that transaction happens here. The capital flows directly from the investors into the company's treasury.
Direct capital formation.
Exactly. But once those shares are purchased, they move immediately to the secondary market.
Like the Nairobi Securities Exchange.
Yes. This is where investors trade those already issued securities among themselves.
You know, I always hear people compare the secondary market to a used car lot.
Yeah, that's a common one.
But that analogy kind of falls apart because used cars depreciate. They lose value.
Mostly, yeah.
A better way to look at it is like a vibrant housing market in a rapidly growing city.
Oh, I see where you're going.
The primary market is the developer selling a brand new subdivision. The developer gets paid once.
Right.
But the secondary market is the neighborhood residents buying and selling those houses to each other over the next 50 years.
And the original developer doesn't see a dime of those subsequent sales.
Exactly. So, and here's my pushback. If this secondary market is just investors trading assets back and forth, how does that frantic trading actually benefit the broader economy?
If we connect this to the bigger picture, the secondary market is the ultimate confidence mechanism.
Business mechanism.
Its primary function is to provide liquidity.
Ah,
Think about it. An investor is only willing to hand over their capital to the developer in the primary market because they are absolutely certain the secondary market exists to let them cash out later.
right. If you couldn't easily sell that house or that share of stock, you'd never buy it in the first place.
You'd be trapped.
Yeah,
So the liquidity in the secondary market guarantees the initial investment in the primary market.
that makes total sense.
But beyond liquidity, the text highlights several profound economic advantages. The secondary market acts as a ruthless barometer of the economy.
Like a health check.
Exactly. Rising share prices generally indicate corporate health and broader economic stability. Plus, it redistributes wealth by allowing the public to own fractions of highly profitable enterprises.
Which is huge.
And perhaps most importantly, it enforces corporate governance.
How so?
By separating ownership from management, public companies are forced by the market to maintain rigorous standards of accounting and transparency just to keep their share price from plummeting.
They have to behave, basically. There is also a brief mention in the notes of the over-the-counter or OTC market, right?
Yeah, the notes point out that the OTC deals in unquoted, often smaller firms.
And it's relatively underdeveloped in places like Kenya.
That's right.
But going back to that vibrant neighborhood analogy, if the secondary market is just this giant confidence mechanism, who are the people actually making it move?
The traders.
Right. If you step onto the exchange floor, you're stepping into a completely different ecosystem. So let's decode the zoo of the stock market.
The zoo, I love
The
them.
notes draw a very sharp line between a broker and a jobber.
Yes, and this distinction is the engine of market liquidity. A broker is simply an agent.
Okay.
They buy and sell securities strictly on behalf of clients, earning their money through a commission. They don't actually take ownership of the shares.
They're just the middlemen.
Exactly. A jobber, however, is a principal dealer. They trade securities in their own right, using their own capital.
So they have skin in the game.
Very much so. They are the ones constantly quoting a buying price and a selling price, making their profit, which is called the jobber's turn, on the spread between the two.
So jobbers are the market makers. They're taking on the actual financial risk to ensure there's always a buyer or seller available.
Exactly.
And this is where we get the famous animal terminology.
The bulls and the bears.
Right. A bull is a jobber who buys shares when prices are low because they're optimistic the price will rise.
Hence a bullish market, dominated by buyers.
Yes.
Conversely, a bear is a jobber expecting prices to decline. They sell securities with the intention of buying them back later at a lower price.
Profiting from the pessimism.
Right. And you'll also see these players aggressively holding on to blue chips.
Which the text defines as first-class, internationally recognized securities.
With unbreakable dividend records, safest bets in the house.
But the ecosystem relies on a third highly specific animal, doesn't it? The stag.
Ah, the stag.
Yeah. Here's where it gets really interesting because I mean, my immediate reaction to the stag is to view them as a parasite.
That's a strong word, but fair.
Well, think about it. The stag operates during the IPOs in the primary market. They buy up new securities they believe are undervalued with the sole intention of dumping them almost immediately for a quick profit once secondary trading
Yeah,
begins.
that's what they do, yes.
They sound exactly like ticket scalpers, buying up front row seats just to flip them outside the venue. I mean, are they actually providing a service or just skimming capital off the top of a new company?
It's a really common critique, but the text explicitly defends the stag as a vital component of a successful market launch.
Vital.
Yes. When a company decides to go public, their absolute worst-case scenario is an undersubscribed IPO.
Meaning they don't sell all their shares.
Right. That leaves them without the capital they desperately need to execute their business plan. It's a disaster.
Oh, I see.
The stags, driven entirely by aggressive speculation, step in and ensure the full subscription of those new share issues.
Wow. Okay, so the scalper is actually doing the venue a massive favor by financially guaranteeing a sold-out show, regardless of who eventually sits in the seats.
That's exactly it. They provide the initial momentum.
That completely flips my view on them.
Yeah. And once those shares hit the secondary market, investors constantly try to impose order on the chaos of those bulls, bears, and stags.
Trying to predict the unpredictable.
Right. The text outlines historical timing systems used to predict market movements. The Dow theory, for instance.
What's that one based on?
It attempts to track the relationship between primary, long-term trends and secondary short-term fluctuations.
Trying to find the pattern.
Exactly. Then there's the Hatch system, which is essentially an early analog version of algorithmic trading.
The Hatch system is fascinating to me because it attempts to completely remove human emotion from investing.
Which is incredibly hard to do.
Almost impossible. But with Hatch, you automatically sell when a price drops a certain, predetermined percentage below its peak. And you automatically buy when it rises a certain percentage above its lowest point.
Pure rules. No feelings.
Right. But the mechanics of how we execute these theories are evolving rapidly. The days of bulls and bears physically shouting at each other on a trading floor.
The old open outcry system.
Yeah, the open outcry system is essentially dead. The markets have digitized and they've expanded aggressively across borders.
They really have. And the notes spend considerable time dissecting this modernization. It starts with the complex decision of a company choosing to list on a public exchange in the first place.
Because it's a huge step.
It's massive. The advantages are clear. Easier access to colossal amounts of capital, reducing your reliance on expensive bank loans, and achieving a clear, market-determined valuation.
We even see cross-border listing, right?
Yeah.
With companies like Kenya Airways and Barclays listing on multiple international exchanges simultaneously.
Yes, that's becoming more common.
Which seems like an administrative nightmare. Why invite that headache?
It's a calculated strategy for risk diversification and reach. By cross-listing, a company taps into a much larger pool of foreign capital.
Okay.
It also insulates them geographically.
How do you mean?
Well, if one nation's domestic economy suffers a severe downturn, the company's overall share price might remain buoyant because it's supported by investors trading in a completely different, healthier overseas market.
Oh, that's incredibly smart. Hedging your bets geographically.
Exactly.
But the text doesn't shy away from the dark side of going public either.
No, it doesn't.
It lists strict minimum share price requirements, massive administrative costs, and endless disclosure rules. It makes me wonder, is going public actually a trap for founders?
A trap.
Yeah, I mean, you get the capital, sure, but the notes explicitly mention loss of privacy and dilution of control. If you have a proprietary corporate strategy, going public means opening your playbook for your competitors to read in your quarterly reports.
Trap implies deception, but it's undoubtedly a profound, often painful trade-off.
Yeah.
The moment you ring that bell, your autonomy evaporates. You have to justify your management decisions to thousands of newly enfranchised shareholders who now hold voting rights.
You answer to the crowd now.
Furthermore, a publicly listed company is suddenly vulnerable to hostile takeover bids.
Right. If the market decides the current management is underperforming and drives the share price down.
Yes. This intense vulnerability and loss of absolute control is exactly why many wildly successful private companies just refuse to list. They prefer to raise funds through private debt to protect their operational secrets.
For the companies that do navigate that gauntlet and go public, the modern trading of their shares is entirely digital.
Entirely.
The notes detail the transition to the CDS, the Central Depository System. We've entered the era of dematerialization.
which is a big word for saying the physical paper share certificates of the past have been completely eliminated.
Which solves an incredible array of logistical and security
Oh,
nightmares.
absolutely. Historically, paper certificates could be forged, lost in the mail, physically destroyed in a fire.
Or spilled coffee on.
Right. With the CDS, ownership exists purely as immutable computer records. And this allows for a critical mechanism called DVP, or delivery versus payment.
Meaning the transfer of the security and the transfer of the cash happens simultaneously.
Yes, in a matter of milliseconds, DVP lowers clearing costs, vastly accelerates market velocity, and practically eliminates the settlement risk that used to plague manual trading systems.
Just boom, done.
Exactly.
Mm.
And overseeing this entire high-speed digital ecosystem is the CMA, the Capital Market Authority.
The watchdog.
The watchdog, yes.
Okay. But the notes make a very crucial distinction about the CMA's power. They do not set share prices.
Never.
They aren't controlling the market value. Their mandate is to grant licenses, operate compensation funds to protect retail investors, and guard against market manipulation.
Which brings us to a massively important section in the text. This sets the stage for the ultimate question of investing.
Yes, let's get to it.
Before we can ask if you can beat the market, we have to look at how the market became so overwhelmingly complex. The text highlights financial innovation.
Right, because the financial landscape isn't static.
No, it's constantly innovating. Driven by rapid advancements in technology, the relentless pursuit of lower transaction costs, and, frankly, the need to navigate or bypass stringent tax regulations.
Finding loopholes.
Exactly. And this drive for efficiency has birthed entirely new financial products, like swaps and complex derivatives.
And these innovations allow institutions to hedge their risks in incredibly precise ways, but they also create a fire hose of new data.
A massive amount of data.
Right. With digital CDS systems executing DVT in milliseconds, global cross-border listings, and complex swaps generating endless streams of pricing information, we arrive at the efficient market hypothesis.
The EMH.
The EMH.
This is the philosophical core of modern finance. It attempts to measure exactly how quickly and accurately a market absorbs all this new, innovative data and reflects it in the stock price.
And the theory is categorized into three distinct tiers, starting with the weak form EMH.
Right. Weak form EMH states that the current market price of an asset already perfectly reflects all past historical data.
Okay.
This means looking at past trends, analyzing historical charts, or using systems like the Hatch system to predict future returns is completely useless.
It's totally useless.
If weak form is true, yes, the daily rates of return are entirely independent of the past. All technical analysis based on historical price movements is a waste of time.
Wow. Okay, then the next tier escalates this significantly.
It does.
The semi-strong EMH implies that the market price reflects not just past data, but absolutely all publicly available information.
Yes. Economic reports, breaking news, quarterly earnings. The moment a piece of information goes public, the digital market absorbs it and adjusts the price almost instantaneously.
So what does this all mean? If we accept the semi-strong form, it means you cannot consistently beat the market by trading on the daily news.
You're too slow.
Right. By the time you read a headline about a supply chain disruption on your phone and open your brokerage app, the algorithms and institutional jobbers have already moved the price. Retail investors are just along for the ride.
That's the reality of semi-strong EMH. But then the text introduces the final, most extreme tier, strong form EMH.
And I have to push back hard on this.
Okay, let's hear it.
The strong form asserts that the market price perfectly reflects all information, both public and perfectly guarded private information.
Yes, that is the theory.
Which sounds completely absurd. It implies that nobody, not even a company's CEO holding a devastating corporate secret, can consistently profit above the market average by trading on that secret. How could an open market possibly price in a secret before the secret is even announced? Does the market have telepathy?
This raises an important question, and it's the exact crux of how modern financial markets maintain their integrity. The text doesn't attribute strong-form EMH to magic or algorithmic telepathy.
Oh, that's good.
It draws a very specific, grounded conclusion. The strong form holds true in reality purely because of the regulatory bodies we discussed earlier,
The CMA.
CMA or the SEC in the United States.
So the watchdogs enforce the efficiency.
Exactly. Insiders absolutely possess asymmetric private information that would mathematically guarantee massive abnormal return.
Right.
But they are legally forbidden from acting on it. Yeah. The efficiency of the strong-form market is not a natural economic phenomenon.
It's artificial.
It is an artificial environment heavily enforced by law, surveillance, and the threat of severe prison sentences. The regulators actively stop the insiders from exploiting their mathematical advantage, which artificially keeps the market price efficient and fair for the public.
Wow. The playing field is only level because the referee is heavily armed and watching every move.
That's exactly right.
Looking back at the sheer scale of the journey we've just taken, we started with a simple saver looking for a return. We traced how that capital flows through the reservoirs of intermediaries, bridging the gap of time through maturity transformation.
Yep.
We mapped the arenas of the money and capital markets and stepped onto the secondary floor to meet the bulls, the bears, and those vital stags ensuring companies actually get their funding.
The zoo.
The zoo. We explored the double-edged sword of going public, the sheer speed of digital dematerialization, and the explosion of financial innovation. And finally, we learned that the market is ruthlessly efficient at absorbing information, keeping the playing field level, mostly thanks to the aggressive oversight of watchdogs.
It's a massive, complex machine.
It is. But this knowledge right here is your toolkit.
Yeah.
The next time you, the listener, are reading financial news or evaluating your own investments, you aren't just staring at a wall of jargon. You can actually see the structural plumbing moving the capital underneath.
It allows you to understand the mechanics of the machine rather than just reacting emotionally to the noise it makes.
Absolutely.
Huh.
But I want to leave you with one final provocative thought to mull over on your own. The academic notes we explored conclude that the strong-form efficient market hypothesis works primarily because central regulators successfully threaten and stop insider trading.
Right.
But what happens to that efficiency in entirely unregulated, newly innovated spaces, like decentralized digital assets or offshore crypto exchanges where there is no CMA or SEC?
Where there's no central referee at all.
Exactly. If the deep efficiency of a market relies entirely on the fear of getting caught by a watchdog, what exactly is the market pricing in when there are no rules to break? Thanks for joining us on this deep dive. Keep questioning the plumbing.